In this lesson, we're going to conclude our overview of the three financial statements for Apple by going through the final step of the process, which is linking together those three statements. So in the previous videos, we went through the income statement of Apple and how it showed the revenue, the total sales, all the way down to the after-tax profit, the net income at the end. We went over how the balance sheet shows Apple's resources, their assets, and then how they acquired those assets, those resources, the liabilities and shareholders' equity side in the balance sheet. We also went over the cash flow statement and why we need this, because unless we create a cash flow statement, we have no idea whether or not this business is actually making any cash, actually generating cash in their bank account. They have a lot of non-cash charges and revenue that show up on the income statement, but which do not actually reflect their cash situation. So once you've completed this much of a model like this, the last step here is to finish linking together everything and to create our new version of the balance sheet, the current version over here. Remember that the balance sheet shows the snapshot of a company's resources at the beginning of a period and the ending of a period. And normally what you do in a model like this is you fill out the income statement first and project the items there. Then you go over and project what you can on the balance sheet. So in this case, current assets we might be able to project independently, and some parts of the current liabilities we might also be able to project independently. Then you go and create the cash flow statement for the period that you're looking at, and you use that to get to the cash at the bottom all the way down here. And then once you have all that in place, you go back to the balance sheet and you finish filling out the current version or the new version of the balance sheet for the end of the period that you're looking at. So some of the key points to keep in mind when we actually link together the statements like this. First off, we are not going to do anything on the income statement. We're not going to do anything on the cash flow statement. I have here no changes if everything is already filled out, because if we had not filled out, for example, the ending cash and cash equivalents right here at the bottom, we would actually have to change parts of this. But we already have our cash flow statement completed right here, so we don't need to do anything else in this particular section. So what we really have to do when linking the three statements is to focus on what happens on the balance sheet. Now, I've gotten a lot of requests for universal rules that always apply when you're modifying the balance sheet. Unfortunately, there are no rules that always apply in all situations without exceptions. The closest we can come to that is exactly what I've laid out right here and highlighted for you, that generally current assets are estimated directly on the balance sheet, long-term assets correspond to cash flow from investing, current liabilities are estimated directly on the balance sheet, and then the last two, long-term liabilities and shareholders' equity, come from cash flow from financing. So those are the general rules, and as you see right here, there are exceptions, so unfortunately we can't do anything about that. But especially if you're new to finance and you're learning this for the first time, don't worry too much about the exceptions for now. Just focus on the general concepts here and use these as we go through and link together the three statements. So generally, current assets are going to be estimated directly on the balance sheet. So these are not going to flow in from the cash flow statement or the income statement. They may be linked, for example, to income statement items, but ultimately they're going to be independent, and you're going to make up your own numbers for these on the current version of the balance sheet. The one exception is cash and cash equivalents. This one is going to flow in from the bottom of our cash flow statement. So for this one, I'm going to use the arrow keys and control and jump down to get the ending cash and cash equivalents from the bottom of our cash flow statement. This is always what you do in models like this. So we're going to take that from right here. So that's the one exception to that rule. Everything else normally you project by itself independently on the balance sheet. We'll get into how exactly you do that in the next course on three statement models, but that's the basic idea for now, that the rest of these numbers are independent, whereas cash is going to come from the bottom of your cash flow statement. We can add that up with alt equals. Then for long-term assets, remember that long-term assets correspond to investing activities. Now again, there are exceptions to that. It doesn't always work directly like that, but that's one way you can think about it, especially if you're new to finance and you haven't seen these before. So how do we get to our new version of the long-term assets right here? Well, it's pretty straightforward. If you actually look at the names of all the different accounts listed, you can pretty much match them up as you'd expect. So for long-term investments, for example, we're going to start with our old number. And then for our new number, what's happening here? Well, we're purchasing long-term investments, and then we're also selling long-term investments. If we purchase investments, we want it to go up, so we're going to use a negative sign in front of that. If we sell investments, we want it to go down, so we're also going to use a negative sign because this is a positive number. So we're adding that 10 and then we're subtracting that 5 effectively, so we get 15 right here. And you would take the same approach if you had any other type of investment. Even if you had a short-term investment under current assets, you would do the same thing, and you would probably pull it in from investing activities and add any purchases, subtract any sales or maturities. For intangible assets and for other long-term assets, it's very, very similar. We simply add in the purchases of these from the investing activities section of our cash flow statement. So for both of these, intangibles, we're going to take the 15 and we're going to subtract the 5. We're subtracting it because, remember, on the cash flow statement, that negative 5 is negative because it represents a use of cash. But on the balance sheet, when we use cash, it's going to increase our assets. So we're going to subtract that. We're going to use a negative sign, and we get to 20. Other long-term assets, we're going to take the old number and then subtract purchases of other long-term assets. Sometimes in models you don't do it exactly like this. There are other items that can come into play with both of these. Sometimes you actually hold other long-term assets constant, but again, for now I'm just introducing the concept and giving you the overall idea of how you link together the three statements like this. Now we get to these two items here, both of which are exceptions, either entirely exceptions or partial exceptions to this rule. So for PP&E first, you might look at this 50 and say, okay, well, we're going to just subtract the capital expenditures here of 20. So effectively, we're going to add it to our PP&E number, and there we go, we're set. There's one thing that we're overlooking, though, which is depreciation. Depreciation, if you recall, just means that the property you own or the plants, the equipment, are losing value over time. Now, on the balance sheet, we want to reflect that lost value. We want to reflect what we're paying for new PP&E, and then also how much we're losing in lost value over time. So what we have to do here is also take into account the depreciation. I'm going to press F2 to enter the cell to modify the formula, and then enter the subtraction sign and go up to depreciation on the cash flow statement, and we're going to subtract it on the cash flow statement right here. So this is a partial exception because depreciation for this line item is coming from the cash flow from operations section. So it is something to be aware of. If you had anything else in here that modified PP&E in any way or was related to PP&E, you would also have to take it into account and therefore pull it in from cash flow from operations. This will become more clear, and some of these other items and the relationships will become more clear when we go through interview questions and how the model would change based on interview questions after this. Goodwill is another exception. Remember that goodwill represents the amount that you've paid for a company over its value according to its balance sheet, which we went over in the balance sheet tutorials. You could also think of it as any type of intangible assets like the brand name of the company, customer relationships that are going to be good for a very long time, a time period that you cannot actually estimate. So anything intangible that adds to the company's value. Goodwill is usually kept constant, so I'm just going to link it to the old value right here. And the reason it's kept constant goes back to what I just said. It corresponds to assets that are going to be good for a very, very long time to come that are not going to clearly decrease in value over time as, say, a factory would decrease in value over time as it wears down. Now, you don't always do this, and in the interview questions, we're going to go over examples of how you could actually modify goodwill in different scenarios. But for now, just keep in mind that most of the time in models, it will be held constant. So this is, in a sense, another exception in that it's not directly linked to anything in investing activities right here. So let's add these up with alt equals. Then let's add up total assets right here. So I'm going to take total long-term assets, enter a plus sign, and add in total current assets. So we get to 210. We know that on the other side of the balance sheet, we must have 210 there, otherwise we're going to be in trouble. So liabilities and shareholders' equity, these three items under current liabilities are all projected independently, so we don't have to do anything. I've already filled those in. The revolver here is the exception. So if you go over to my rules on the right side right here, we estimate these directly on the balance sheet. The exception is the revolver, which is going to flow in from the cash flow statement instead under financing activities right here. If you have different types of debt, you'll see an entry for each of these under financing activities most of the time. And in this case, we just have this one entry for the revolver. for this particular debt item under current liabilities. So remember the signs here, that if we pay off a revolver, it has a negative sign and our revolver balance goes down. If we issue more in revolver or we draw on the revolver, we have a positive sign and it goes up. So in this case, we are fine just taking the old balance and then simply adding this line item for the revolver right here. So it goes down by 5 in this case because we're using 5 of our cash to pay off this revolver. Now let's add these up with alt equals. We get to 85. Now for long-term liabilities, again, if you go over to my rules for how you project this, long-term liabilities are generally going to come from the cash flow from financing section. The one exception here is deferred tax liabilities. Another possible exception here is any kind of pension obligation for companies. In both cases, deferred tax liabilities and for pension obligations, they are instead going to flow in from the cash flow from operations section because they're more closely linked to the company's operations than they are to their financing activities. So that's the one exception here, but the rest is pretty straightforward. For long-term debt, again, we just go over to the corresponding item on the cash flow statement. We issue or pay off long-term debt. In this case, we're issuing additional debt, so our balance is going to go up. So we take our old number right here, and then we add the issuance right here. Deferred tax liabilities. This is our exception. What we're going to do here is take our old balance and then go up to our cash flow from operations and pull in the deferred income taxes from here. Why are we doing this? Well, remember, by deferring income taxes, it means we're paying less right now, and then in the future periods, we're going to have to pay more. We reflect that obligation to pay more with the deferred tax liabilities line item right here. And that's why it's going up in this case, because when we put off and postpone payment, it means we're going to have to pay more in the future, and as a result, our balance is going to go up. Other long-term liabilities is much more straightforward. We simply take the item and then find the corresponding item in the financing activities on the cash flow statement. So in this case, it's changing by 5, and we're just going to add that directly. Sometimes in models, other long-term liabilities are actually held constant, so you will see that as well. Let's add these up now, alt equals, and then let's add up total liabilities. So we have that in place, 135. So far, we are still well below our total assets of 210, but that's okay because we still have to fill in our shareholders' equity right here. Now, under shareholders' equity, you'll see that I've combined common stock and additional paid-in capital. The reason I've combined them, remember that common stock refers to the book value of a company's shares. APIC refers to the market value of those shares. The reason why I've combined them here is because in models, it doesn't make a difference which account you're dealing with. You can treat them as the same because an item like issuing common stock, for example, is going to affect both of these proportionately. So from a modeling perspective and from a time-saving perspective, it helps us a lot to simply combine the items here and to account for everything all together in the same spot. If you remember on Apple's financial statements as well, if you go to their balance sheet where they list right here, common stock, no par value, they are actually doing this very same thing right here. What they're doing is combining common stock and APIC, and they're saying in their case that the common stock actually has a par value of 0. So no value on paper, so they're solely listing the market value of the stock that has been issued right here. So it's very common to see in models, and that's why I'm modifying it slightly here. So what goes into common stock and APIC? Well, the most common item by far is any type of common stock issuance. So if the company is going through an initial public offering, you would add the funds from the IPO right here. That's where it would show up. If they're just issuing stock to employees, for example, it would also show up here because they're creating new shares in the market. If they're issuing a secondary offering, so they're already public and they're selling new shares to investors, that would also show up here. So those are all common occurrences. For this one, we're going to take the old balance and then we're going to add in common stock issuances right here. And then the exception here is that we actually have to go up to our cash flow from operations and add in stock-based compensation. So why are we adding stock-based compensation to this? I said before that APIC is to represent the market value of the stock over what the book value is. And in this case, it doesn't really make a whole lot of sense intuitively if you think about it, because it's not as if we've sold the stock to new investors per se. It's really that we've just granted employees stock options or common stock, for example. So why is it here? The answer is that we want to reflect dilution to existing shareholders. So dilution just means that existing shareholders' ownership goes down. So in this case, if we have 20 shareholders originally and they each own one of our common stock in Apex, so 1/20th of the company, well, if we issue shares to employees, for example, and we did not reflect it here, we would be undercounting the dilution. So let's say, for example, that we only showed 25, then we might say, okay, after the fact, after we take into account this new issuance, the existing investors from before still own 1/25th of the company. But that's actually not what happens, because if we have additional shares that have been issued on top of that, they actually only own 1/30th of the company now. So that's the reason why we have to include stock-based compensation under the APIC line item right here. Sometimes in investment banking, they will not even do that. They might just have a single line item for shareholders' equity. So that's another possibility as well. But that's the basic idea behind why we include it here. I know it's a little bit counterintuitive, but that's how you can think about it. Treasury stock. The purpose of treasury stock, remember, is that we want to reflect any stock the company has repurchased. So we take our old number, and then we go to our cash flow from financing section, because that's what corresponds to shareholders' equity, and we add in common stock repurchases. By add in, I mean we want this balance to go down to become more negative if they've repurchased any stock, which they have right here. Remember that this is always shown with a negative sign because it's the opposite of common stock in APIC. For retained earnings, remember, retained earnings correspond to how much we've saved up over time out of our after-tax profits, our net income, minus however much we've issued in dividends. So for this one, we're going to take the old number, and for this one, we can actually go to the income statement, or we can just pull it straight from the cash flow statement right here and take our net income number directly from here. And then we want to take out any dividends that we issue to those shareholders. So effectively, this is showing us over time what we've saved up from our after-tax profits minus however much we've paid out over time to our investors in this company. So here it's 48. And then accumulated other comprehensive income. This is for any other miscellaneous changes that have not shown up elsewhere. We're going to take our old balance, and then the only other item that would go in here is the impact of the FX rate change. So we're going to add that in right here. So that takes us to the end of how we link together shareholders' equity. I know it's a little bit confusing, some of the parts with stock-based compensation, and maybe the concept of retained earnings is a bit confusing if you haven't seen it used in a full model yet. But again, this is just intended to be an introduction. Don't get hung up on all the specifics here. I'm just introducing the concepts and showing you how to link these together generally. So now let's go back and add up everything and make sure our balance sheet actually balances now. Total shareholders' equity, I'm going to press Alt equals to add this up. And then we're going to add the total shareholders' equity to the total liabilities. We get 210, which matches assets, so our balance sheet balances. Let's just do a quick check and take total assets minus total liabilities and shareholders' equity, and we get OK for our balance check. So our balance sheet balances. This is something you should always do at the end when you've created the new version of the balance sheet. Remember, assets always have to equal liabilities plus shareholders' equity. If it's not true, if your balance sheet does not balance, your model is completely wrong. So that is how we go through and link together the three statements. Just to recap everything we went over, generally you're not going to have to change anything on the income statement or cash flow statement when you do this. It's really the balance sheet that is going to change the most. For each of these balance sheet categories, there is a general rule, which I have on the left, and then exceptions, which I have on the right. Current assets generally estimated directly on the balance sheet, except for cash, which comes from the bottom of the cash flow statement. Long-term assets generally coming in from cash flow from investing, except for goodwill, which is usually held constant, and then PP&E, which also, in addition to CapEx, has to incorporate depreciation. Current liabilities generally estimated directly in the balance sheet, except for debt, short-term debt, and the revolver specifically here. Long-term liabilities, shareholders' equity, both coming from cash flow from financing, except for deferred tax liabilities, sometimes pension-related items, and then on shareholders' equity, except for APIC, which also draws in stock-based comp, and then retained earnings, which also incorporate net income from cash flow from operations or directly from the income statement. A general rule of thumb that is good to know is that each balance sheet item must be reflected once and only once on the cash flow statement and vice versa. The only exception here is for items that are held constant anyway, such as goodwill. So as an illustration of this rule, if we go back here and we look at depreciation, for example, if we had listed depreciation on the cash flow statement in two spots, so if we had it under changes in operating assets and liabilities for some reason, that would be a mistake because it only shows up once on the balance sheet for plants, property, and equipment. Property, plant, and equipment here. Likewise, let's say that we were reflecting the change in accounts receivable on the balance sheet twice on our cash flow statement. Once in changes in operating assets and liabilities, and then once in, say, investing activities. Well, that would be another mistake because we're showing it twice. The most common way you can make this mistake is if you forget to include something altogether. So let's say you're going through and you forget to include stock-based comp within shareholders' equity. That is a very, very common mistake, so that's the most common problem that you see here. So just watch out for that. When you're going through and checking your own work, that's one test you can use to quickly check everything. At the end, the balance sheet must balance. Assets must equal liabilities plus shareholders' equity. If it is not balanced, then your model is completely wrong. Later on, we're going to get into some details and some examples of how to actually error check your model and resolve problems like this. But for now, just keep in mind this general principle that always must apply to your models. And then as one final note, don't worry too much about all the details. I realize that we went through a lot of material in these lessons, and especially if you're new to accounting and finance, it is a lot to absorb. It's going to get much easier and you'll understand it in much more detail when we go through the interview questions and contextualize it, and when we go through the three-statement model and learn about how to make projections over a number of years. So don't worry if you didn't get all of this right now. I know it can be confusing. I know there are many exceptions to the general rules that I just gave, but just understand the general principles and why we need these three statements, what they actually mean, and where these items usually come from. Coming up next, we're going to get into more detail and look at interview questions around the topic of accounting and see how individual changes to line items on these statements affect all the other statements. And then after that, we're going to get into the three-statement modeling course where we look at how to project the income statement, balance sheet, and cash flow statement over a number of years into the future.